All right, guys, welcome to week 3 of selling weekly lottos. You might notice that the background's a little different. It's because this week I'm in Italy. Last week I was in Brazil. This week I'm in Italy, and that's because this passive income pays for my life. I don't need to go to work. I've been work optional for over 5 years, and just selling these options. All right. So this week's winner is me. Let's check out the results right here. All right, you'll notice this week I made $1,560 and I sold 2 options this week. All right, let's take a look at the first option, the gold call right here. All right, I don't want to get too into this week. If you want to know more about call options, check out my week 2 video. All right, I give a lot of details about to me, how I interpret selling call options, especially on gold. All right, let's take a look at the second option this week right here. All right, you'll notice this is a put contract, okay? Specifically an IBIT June 27th, 59p. Now, I want to talk about put contracts. They're the exact opposite of a call contract. A call contract, the speculator or the gambler is betting on the stock going up. But with a put contract, the gambler is betting the stock will go down. So if the stock doesn't go down, that's when you get the profits as the put seller. Now, it doesn't always have to be a gambler or a speculator in this case. I like to think of put contracts, selling them, kind of like insurance on someone's securities, someone's cryptocurrencies, someone's commodities, whatever you're selling them a put contract on. Okay, so this person, they paid me to protect their stock in case it goes down. So in this case, the IBIT, all right, they gave me $1,000 to protect their stock from going below 59, all right? So if the stock starts to go below 59, I'll have to buy the shares and I'll start taking the hit. But because I got the $1,000 in premium, that's pretty much the equivalent of saying 58. Anything below 58, and I'll start taking the losses instead of the person that might hold those shares and is protecting their share value by buying a put. So the reason I like this is because it's very easy to calculate how much you can make. As long as IBIT didn't go below 59, I get the profits, okay? So let's take the next few minutes of this video and I'm gonna do some calculations with you. I'm gonna change it to a different screen so I can talk to you while I'm doing the math. But I want to show you how I calculate these earnings and the percentage yield, and how it can be really easy for you to do the math and figure out how much you can earn every year by doing this, okay? So let's go ahead and do some math. All right, guys, let's do some math. So one of the reasons I like this strategy is because you can, to some degree, a pretty good degree, like estimate how much you're going to be making per year by doing this strategy. So the first thing we're going to look at is that the 3 weeks so far I've been doing this. Week 3 income, 1560. Week 2, 930. Week 3, 430. Okay, now you'll see here I got this yield percentage, and the way I do that is really simple. I take the weekly income and divide it by the risk. I'll just show you that right here. So first thing you want to do is have your parentheses, okay, 1560, and you're going to use this parentheses, or not parentheses, like the slash for a divide, 215,000, all right? And then you're going to multiply that by 100 to get the percentage, okay? So you can see here, 726. Now, Apple, I guess, likes to have 3 decimal places. I like to have 4. All right, and do that with the same each time. Your weekly risk, right? and take your income divided by the weekly risk. So let's do it again. Just the same exact thing. It's going to turn out the same way. 930 divided by 156,000 times. Oh, I didn't need to put this equal sign here. Sorry, I was doing like Excel. Times 100 equals, okay, 0.596. Did it again. All right. Same thing's gonna happen with the 430. So I'm not gonna show you that one. Same thing's gonna happen. It's gonna get the same number as I got because I did. It's the same thing. 430 divided by 120,000. All right, times 100. You're gonna get 0.3583%. That's the yield that I'm getting. All right. Now we're gonna take the average weekly risk. That is 163,666.67. All I'm doing here is taking the 3 weekly risks: 215,000, 156,000, 120,000. All right, I'll just keep showing you. Okay, 215,000 plus 156,000 plus, what was the last one? 120,000. Equals 491,000. All right, and then divide that by 3 equals, oh, they're not letting me do that. Okay, hold on, gotta get these parentheses here. I guess not that advanced. Divided by 3 equals 163,666.667. All right, same thing as I got. Why'd that go away? All right, same thing I got. All right, same thing you're gonna do with the total income, or not the total income, but you're just gonna add those incomes up. So 1560 plus 930 plus 430, that equals 2920 right there. All right, I'm not gonna show you that math. It's like basic, simple math, just adding. All right, now the average weekly income, you're gonna do the same thing as average risk. Okay, you're just gonna take the total income, 2920, and divide that by 3, and you get 973.33. I'm not gonna do that math for you. This is pretty simple. All right, here we go. This is the average weekly percentage yield. All right, this is an important little number. I'm getting 0.5947%. That's a little bit better than 0.5% per week. All right, and all you're gonna do is take the average weekly income. I'll do this one for you. Average weekly income, which is 973.33, and divide that by your average weekly risk. All right, it's the same as up here to get this yield. All right, so 163,666.67. You can multiply that by 100. You gotta use that little star sign. All right, 0.595. All right, I like 4 decimal places. Apple likes 3. All right, now very simple. You're going to potentially calculate your yearly income. Now this is potential because it's going to be almost impossible to do this every week the same exact way. So this is just potential yearly income if you do the exact same thing every week the same way, which is pretty close to impossible because there's too much uncertainty in the market. Everything changes every week. So this is just basically your potential if it goes the same way. All right, this number is going to be changing by next week. All right, all you're going to do is take your average weekly income right here and multiply that by the number of weeks in a year, which is 52, and you're going to get 50,613.33. All right, and then the potential yearly percentage yield, you're just going to take your average weekly potential. Why'd that go all the way up there? Average weekly potential yield. All right, and you're going to multiply that by 52, and that's going to get you 30.92%, so almost 31%. All right, so there's the math. So you can see that with just $163,000, I'm able to potentially make $50,500 per year. $160,000. I'm almost making $1,000 a week. That's just potential. Obviously, things can go really wrong with this strategy, and I can lose all my gains for the last 3 weeks in just one big market crash that happens over the course of a week or a month. But for the time being, I'm averaging $1,000 a week off of just a bit more than $160,000. Now compare that with something like a high yield savings account. In order to make a $1,000 a week return with a high yield savings account at like 4%, you need to have more than $1,250,000, 1.25 million. Obviously, that's guaranteed the lowest risk you can get. But if you want to compare it to something like index funds on average compound 10% a year, right? To make $1,000 a week, you'll need to have over $500,000 in index funds. So with this, I'm actually making, with $160,000, what others would be making with $500,000 in index funds or 1.25 million in a high yield savings account, which is why I like to do this. But again, it's not risk free, guys. This is more risk. This is why I'm getting these higher yield returns for the time being, is because there is a lot of risk. In the case Bitcoin fell like below 100,000 and kept falling to 90,000, I would have lost multiple thousands of dollars. But luckily for me, I sold the put and it bounced back above $100,000. So there is a good deal of risk involved. So don't just think this is free money. Don't think this is guaranteed money. These options, they're priced like this because of the risk. The risk is factored in to the stock. So there you go. There's my week 3, and I will see you again for week 4 next week. Take it easy.